Good morning and happy Sunday to everyone out there. It is Colby, the DGI Crab, coming at you August 31st, Sunday morning, 2025. Here every single week on a Sunday morning, we're going to make a plan going into the upcoming trading week, take a look at what dividend growth stocks in the market look to be undervalued at the time, and try to figure out where we're going to deploy that capital to acquire that sweet, sweet passive income that we could utilize to build a bridge to our financial freedom and early retirement. In case you're new to the channel, I only focus on 60 individual high-quality dividend growth stocks, and I've split them into 4 separate tiers based on the age and time horizon of the investor, which I believe is the most important metric that any dividend growth stock investor should take into consideration when making their purchases. The big news this week in an otherwise hot stock market, as the markets continue to do pretty well overall, is the absolute crash of Hormel Foods. Their earnings report wasn't particularly encouraging. They've readjusted their guidance. Profitability is hurting. However, there are still plenty of reasons to be happy about the idea of acquiring more shares of Hormel Food. I'm going to get into that and more as we go into the 4 tiers here today. Now, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment purposes. The opinions expressed regarding investments are my own, and you should always perform your own due diligence prior to investing your hard-earned money. For those of you that are new, this is my personal strategy of investing, where I put about half at least into age-appropriate ETFs when I make my investment allocations each week. I'm looking for stocks in my list that are yielding at least 30% or more above their 4-year average yield, with some exceptions. I have a top 10 favorite group of stocks that I will sometimes invest money in, whether they looked cheap or not. I remain within my age tier unless there's a stock in another tier that's hit that 50% or more higher than the 4-year average yield. And then at that point, the floodgates are open. I think it's a good investment regardless of how old I happen to be. And if there's not a buyable stock within my particular age tier in a given week, I'm going to either be looking for the 50% or more undervalued stocks in other tiers. I'm going to look at my top 10 favorite stocks, or I might just add more money into the ETFs for that particular week, as opposed to just doing half of the allocation that way. So now we're going to jump into the 4 tiers spreadsheet here as we start with the tier 1 investors. This is a group of investors age 30 and younger. Good group of stocks for them to focus on. Your starting yield with this group is not going to be high. Let's just be honest. We're talking about stocks that are usually going to be yielding collectively in the mid 1% range. But as a group, we want to get really high dividend growth year over year, well above 10%, because this younger group of investors has plenty of time in the markets. They've got a lot of time to build up positions in these low yield, high growth positions that are going to grow year over year like clockwork, that dividend by 10% or more. And that can put you in a really, really good spot if you get a good early start on these. United Health, way undervalued. See, these are sorted by the valuation tab where I'm comparing the 4-year average yield to the current day yield to get this valuation number. This is going to be pretty similar to what Simply Safe Dividends does when they're deciding whether or not a stock is looking undervalued. I've just sort of reverse engineered what they're doing here for my purposes. Pretty simple to do. But anyway, UNH, green light for any age tier to continue to add to that UNH position, so long as they are down here in the low 300s especially. I think that this is one that you just add to it right now while things are not looking so great. And then in the future, when things inevitably turn around for a juggernaut like UNH, you'll be really happy that you were able to build up a nice, comfortable position in that company while they're trading way down. Same could be said for Nike, which is starting to show some interesting recovery signals. They haven't dropped down into the 60s for quite a while right now. The mid to high 70s is starting to feel pretty stable for Nike, so maybe they're going to start to rebound here after a little while. Nordson was coming close to slipping out of the buy zone, but then they did a dividend increase this past week, increasing the amount of money they pay out per share per year in dividends. So that made their dividend yield go up a bit. And then the next thing you know, they're still in that buy zone. Still liking Nordson here in the tier one category. Nothing else looks even remotely viable right now. And I don't sell stuff, I'm not selling my, gosh, I wish I had a bigger Broadcom position. Oh man. But yeah, I'm not selling my pretty small position that I have in Broadcom. It's been up forever since that's one that looked like it was trading at a reasonable deal, and that stock just keeps going to the moon. Absolutely wild there, Broadcom. But that 4-year average yield does continue to move down a little bit. I update this number on all of these, you guys, every single week. Tier 2, age 31 to 41-year-old investors. This group's going to yield higher than the Tier 1s. So we get a little bit older, a little bit less time in the market. More in the 2 to 3% range, high single digit year over year dividend growth. That's what we're trying to get out of this group of stocks. And we're still sitting here with 3 stocks in the buy zone, almost 4. McCormick and Company just missed getting in here. Really, right around $70 a share is the sweet spot on McCormick. I've been kind of adding little bits and pieces to my McCormick position here and there anytime it dips below $70. And sometimes it's just going into the brokerage real quick and just saying like, throw 10 bucks at it, throw 20 at it, just small little amounts like that, just over time, are going to build up that passive income stream as you go. Hershey has almost exited the buy zone here. They're getting very, very close to doing so, but still at 183.75 is good enough for me to continue to add. Really liking AWR and Target at these prices. If I had to pick one or the other, even though Target's really, really undervalued right now, it's hard for me to turn my nose up at adding to AWR whenever its yield starts to get up high like this, up into the high 2%. It's just so consistent. But Target, again, is above that 50% undervalued mark, so any age tier, in my opinion, could take a bit of a roll of the dice on Target right now. Add it when that current yield is really high. Just start with a pretty good high yield. And then if their yield growth is a little slow for the next few years, it's not the end of the world because you got in at a really high yield. And I think eventually Target will get back to doing better dividend increases than they've done of late. But in the short term, probably not. Tier 3, age 42 to 53-year-old investors, the yield continues to climb up the higher end of the tiers that we go here, more in the 3 to 4% range as we move up into this tier. Growth rate slows down a little bit. We're looking at anywhere from like 4 to 7% with this tier. Only 2 right now that are in that buy zone. One of my top 10 favorite stocks, of course, is Pepsi, and I have been pretty consistently buying Pepsi week in and week out for a little while right now. Very happy to do so with this yield here in the high 3s, getting Pepsi with a starting yield above 4%. Probably one of my top 3 favorite things that I've been able to add so far in 2025. Hormel, as I mentioned before, they absolutely crashed. That puts them into not only the buy zone, but into the green light for everyone to buy zone. And because they've been down for a while, their 4-year average yield just kept continuing to tick up little by little. They had almost gotten out of the buy zone entirely because this 4-year average yield continued to climb. And then when their stock just dropped and their yield shot up, they remain firmly entrenched. That payout ratio sitting in the high 70% is a little concerning. But I will say I did a double check on the Simply Safe dividends. They've still got Hormel sitting there at about a 90 on their safe score as far as their dividend safety is concerned. So again, kind of like Target, I don't think you could expect great dividend growth out of this one in the immediate future. But Hormel's a dividend king, you guys. Let's take a look here at them on Seeking Alpha real quick. Just a quick detour. We're going to hop over to the dividends tab just to remind you guys we're talking 58 consecutive years of dividend growth. You think Hormel's had some bad quarters in the last 58 years that has caused their stock to crater from time to time? Yeah, I think they probably have. It's probably a pretty safe assumption. But right now, 4.5% starting yield, 5-year growth rate of just under 5%. That's a little misleading, though. We're going to take it one step further, look at the growth history on the dividend. And here's what we can see. Last year, pretty small dividend growth, but still growth, 2.73%. This is probably going to be what we're looking at with Hormel for the next year or two. And that's why the share price is down. People aren't expecting to get the wild growth that they got. And it's been slowing over the years, but you can see respectable growth, right what we want in that tier 3 category, 5-6%. And then just a straight decade from 2010 to 2020 of double digit dividend growth. Hormel was a monster growing that dividend in the 2010s. We look back here to the 2000s. Also very steady dividend growth, more in that mid to high single digit range. But Hormel, excellent. Through the financial crisis, wasn't really a consumer goods type of a thing, but 2009 they got through that just fine with the dividend increase. So I'm pretty bullish on Hormel right now. I understand why people are apprehensive in the short term, but a dividend king typically doesn't trade this cheap unless there's reasons people are have for being apprehensive in the short term. So I am going to enjoy the high starting yield, and if this happens to be one that we guess incorrectly on, we can always move out of it later. But I think that this is a pretty safe bet right now. I'm pretty happy to add Hormel. Tier 4, age 54 and older investors. Still no bargains in this high yield category, you guys. You know, the older crowd, a lot fewer years in the market. You want to get high starting yield. You probably want to start at least 5% in most cases. Still want to get 2 to 3, maybe 4% dividend growth year over year. On this high yield stuff, you don't want to buy things that have NAV erosion and do dividend cuts and things of that nature. This is a pretty steady group of 10 that can accomplish that, but no screaming buys in that category. So, guys, let's talk about allocations now for the week. We'll start with the ETF side. As I said, at least half of my money goes into ETFs each and every week. For the tier 1 younger investors, I like the combination of S&P 500, small cap, VIG, and VYMI. For tier 2, I like the same 4 categories, but just with different allocations, as you can see. With tier 3, SCHD, VYM, DHS are the ETFs in that particular category, although DHS is starting to be on my watch list, if you will. I might have an idea of ETF that I could replace DHS with. Starting to get a little bit impatient with that one, but we'll wait and see. I'll keep you guys posted on that one. And then tier 4, loads of different ETFs to take a look at. And since there's nothing in that tier 4 buy zone category, this particular group has been just doing ETF double down for quite a while right now. Instead of doing little 5% allocations in all of these income generating ETFs, I'd be doubling down to 10. But let's talk about just the stocks in the tiers, kind of where the priorities should be. If I'm in tier 1, I'm going to prioritize United Health and Pepsi above everything. And then Nike, Nordson, Target, Hormel would get the rest of my attention. In tier 2, Target's the top priority, with Pepsi as the secondary. And then UNH, AWR, Hershey, Union Pacific, and Hormel all in my buy zone for now. Tier 3, Pepsi's the main priority, with Hormel followed right behind that, with Target, UNH, and Procter & Gamble deserving a little bit of attention in that Tier 3 category. And then finally, ETF double down in Tier 4, with the exception of VYMI. I still think UNH yielding in the high twos isn't even a terrible thing to purchase for the income seekers, because you could always wait for the turnaround, sell off the shares again later, or just have something that grows. Keep investing, everyone.